Now we're going to turn to the pseudo-dividend method. The pseudo-dividend method is going to use what we call equity valuation cash flows, or you may have heard of them as free cash flows. These are the cash flows available to be paid to shareholders, and they're going to turn out to be the same as those dividends that we estimated in the dividend in the maximum dividend method. So in this method, what we're going to do is we're going to forecast dividends explicitly to be zero. So there are no dividends in this free cash flow methodology. All right. Instead, what we're going to do is we're going to calculate our equity valuation cash flows, and we're going to do so making sure that we omit surplus cash from our working capital calculation. Now, this is a really critical piece and one that a lot of times we mess up, but it's actually an easy mistake to catch. So if you're in a situation where you've done your valuation cash flow calculation, and I'll show that to you in a minute, and you're getting zero equity valuation cash flows, right? Every year it's zero. The mistake you've made is that you haven't actually subtracted surplus cash from your working capital account. And the idea here is if you've included surplus cash in your working capital account, then what you're saying is any surplus cash that you get is required for working capital. If that's the case, then there's never going to be any surplus cash to pay out to the company because you're saying it's required for the business and it's in that surplus cash. So it's going to be really important, and I'll show you this in a minute, that we remove the surplus cash from our net working capital calculation. That way we actually get cash flows to flow through. The other important thing to note before we look at a couple statements, financial statements, is that we're going to have surplus cash growing along the way. Surplus cash is going to get bigger each period as we generate more cash from the business. Now, as we go, we're going to be thinking of paying that surplus cash out as our pseudo dividends. So it's important that when you see this cash account build over time, that you aren't tempted at the end to then say, oh, look, we can pay out all this surplus cash now to our shareholders. And the reason is we've been paying it out over time. And that'll become clearer as we look at some examples. Before we do that, let's actually move on to our next slide here to look at our financial statements now, this time with zero projected dividends, right? So unlike the maximum dividend method, we have no dividends projected here, right? No equity issuance either. Instead, what we have is a surplus cash line that's no longer zero, right? This is the way you've been trained so far to build financial statements, in that you're basically plugging for cash at the end. And here, it's a little bit different because we're plugging for surplus cash. Required cash is an assumption, and so surplus cash is that plug that we still use where we take, total assets minus our net fixed assets minus all of our other current assets besides surplus cash. So that'll include things like inventory, accounts receivable, and that required cash that we have. All right, so this surplus cash line is now what we can use to get our valuation cash flows out. Importantly, the change in the surplus cash is going to be equal to our valuation cash flows. All right, we'll return to that in a minute. First, I want to show you kind of the explicit way to calculate these valuation cash flows. And this is a formula you've probably seen in a prior class, but we'll just go over it again. So what we're going to do is basically start with net income, and then we're going to add and subtract things that are either cash charges that don't show up in the income statement, or that do show up and reduce cash but aren't really a cash expense. All right, so we start with net income, and what we're going to do is add back in depreciation and amortization. So both depreciation and amortization are non-cash expenses, right? They're going to reduce our income, but they don't really cost us cash. And that's because they're part of fixed assets that we've bought in the past, and we're just accounting for their use over time through depreciation. So we're going to add those back in because they're non-cash charges. We're then going to subtract our change in net working capital. And importantly, it's the change in net working capital here, right? Because if we, for example, are growing our business and we need more inventory to support more sales that are coming, well, that's going to increase the amount of inventory we have. And if you recall, an increase in inventory means that cash has to go down. So if we increase the amount of working capital we need, that means less cash is available to be paid out to shareholders because we need to use that cash to buy that extra inventory. And this is the step where you have to make sure where you don't include surplus cash in that change in net working capital. All right, so surplus cash is not in your net working capital when you're doing this calculation. The next thing we do is add back in, subtract capital expenditures. So capital expenditures, this is where we're buying our new machines or buildings or vehicles that help us run our business, right? You remember we added back depreciation on kind of that second item there. Here we're subtracting any cash that we're having to reinvest in our business to keep our business growing and operating according to our business plan. So that's cash that we don't have available to pay out to shareholders. Now, lastly, we're going to add debt back in. And this one sometimes feels odd to people because typically when we raise debt, we use it to do things like, purchase investments. But that's not necessarily required, right? When we make an investment in an asset, right, that's a separate decision of how we finance that asset, right? We can finance it with cash that we have on hand. We can raise debt to finance the purchase of that asset, or we could raise equity to get the cash needed to buy that asset. But ultimately, how we finance it is independent of whether or not we make that investment. So any money that we raise from debt, for whatever reason we raise that money, creates extra cash that we can then pay out to shareholders, right? If we buy a big investment with it, well, that increases our CapEx, so we don't have as much cash to pay out to shareholders, right? But that's the investment decision separate from the financing decision of kind of where we're getting our capital from. So we're going to add debt in because any extra cash we get from debt is available to be paid out to shareholders. And then at the end of the day, adding all those together gives us our valuation cash flows, VCFs, or free cash flows, FCFs. Now let's see what this looks like with our example we've been working through. And if you want to look back, you can go back to the prior slides and kind of see each of these numbers are coming from the income statement or from the statement of cash flows, right? We start with net income. We then add back in our depreciation and amortization, subtract our change in net operating working capital, again, not including surplus cash, subtract off our capital expenditure, add back our debt, and that's where we get our equity valuation cash flows. And notice I have been saying equity valuation cash flows, and this might be slightly different than how you've seen this in other classes. In other classes, you might have started with something like EBIT at the top instead of net income, and that's because you might be adjusting for debt, right? If you have debt in your capital structure, then you're thinking about, okay, well, we need to account for the interest expense and recognize that we're then going to, we're going to basically back out our interest expense, and then we're going to use a weighted average cost of capital later. I'm building this right now that we focus on the cash flows to equity, and so when we actually value this, we're going to have to use an equity discount rate. So it's a slight distinction between whether you're doing full enterprise valuation or, in this case, focusing on equity valuation. At the end of the day, they're pretty similar ways. We just tweak them slightly depending on what kind of cash flows you're going to get. So the important thing is that you marry whatever cash flows you have with the appropriate discount rate. Now, the last point here, and what I want to show you, is that valuation cash flows are equal to changes in surplus cash. So when we build our financial statements, right, you guys have been used to building net income, balance sheet, statement of cash flows. And the statement of cash flows serves as a check to make sure the income statement and balance sheet are constructed properly. Now we're going to essentially add a fourth statement, these valuation cash flows I'm outlining on this slide, and then the change in surplus cash should always be equal to those valuation cash flows. So it's an additional check that we can build into our model to make sure the model is working properly and everything is lining up. So let's actually now flip over to an example so you guys can see this more in a spreadsheet. All right, so you see that this spreadsheet looks pretty similar to what we've looked at before. And actually, most of the numbers are the same, at least in the present values and the total value, as the maximum dividend method. Remember, I told you they're going to give us the same answer. The difference is going to be in the fact that we're going to start from that surplus cash flow line from the balance sheet. So again, assume we have those financial statements built somewhere else. Here I'm just taking that surplus cash line directly from the balance sheet. Now to get the valuation cash flows, all I'm doing is taking the change in the surplus cash. Again, this will be equal to the valuation cash flows if you start from net income, add depreciation, subtract change in net working capital, subtract CapEx, and add back in debt. You're going to get the same numbers because those are mechanically linked to one another. That said, once we have them, we can now do the change in the surplus cash. That's going to give us our valuation cash flows, which are the same as what we saw in the last model. And that's why we end up getting to the exact same present value, doing the same terminal value and reversion value calculation. So the appeal here is that now we can just pull this straight from the balance sheet. We don't have to explicitly forecast dividends, and we can ultimately get the same answer back out. So to summarize, the maximum dividend method and pseudo dividend methods are going to give us the same answers. Maximum dividend method is kind of conceptually or intuitively easy. We can think about the actual dividends that would be coming out from the company. But again, that's not really very realistic. The pseudo dividend method is more what practitioners expect to see, right? You have reasonable looking financial statements, and we get the same cash flows that we can use for valuation purposes. So we get to the same answer either way. Pseudo dividend method is really superior because it lets us kind of make things look the right way. I introduced maximum dividend method to give you kind of more of a conceptual basis for why we're doing this and how we get the same amounts from maximum dividend and pseudo dividend as far as our cash flows go. Now, in both the pseudo dividend and maximum dividend methods, most of the value of the cash flows, again, are coming from that terminal period. So again, I'm going to link back to what we said before. We have to be careful to be kind of reasonable in our assumptions around the terminal value period. And basically the terminal discount rate, terminal growth rate, and what that final cash flow is going into the terminal period to make sure we've really gotten to kind of stable, steady state growth at that point. Now, the next method I'm going to show you is the venture capital method. And this is basically going to assume that we don't have any interim cash flows, and instead we just think about how much cash do we get at an exit value. So terminal value is often called exit value by venture capitalists. We're going to discount that back to today, and it's going to be a little bit more conservative estimate of the value of the company. And we'll talk about why that is in the next set of videos.